Ashlisha.
Good morning, namaste to all the participants, speaker of the day, AIC team members. and Arthayan team members. I welcome all of you to this Tuesday session. And the speaker of the day is Mr. Sandeep Tatke. And I welcome team Arthayan to introduce the speaker of the day to the audience and moderate the proceedings.
Sure. Thank you, sir. So today's speaker is Mr. Sandeep Tatke. He's a chartered accountant and a cost accountant and also holds a bachelor's degree in commerce from the University of Mumbai. He has 23 years of experience in corporate finance in various industries. Currently, Sandeep is designated as the Senior Director of Indian Subcontinent and CFO India for DSV Air and Sea Private Limited. He is also a part of the executive board at DSV Indian Subcontinent. Previously, he has worked as a senior manager of finance for Royal Bank of Scotland, regional finance controller for FedEx Express, and director of finance for Nielsen India. So today he would be walking us through how to structure a deal for fundraising from a startup point of view. So, as all startup founders know that structuring a deal is one of the most critical aspects of their fundraising journey. And here we will help them understand structuring, and we will be covering various funding instruments like convertible debentures, preference shares, iSafe notes, so on and so forth. The speaker will elaborate on the pros and cons of each type of deal and how should the startup be making decisions at that stage. The session will be followed by a Q&A with the participants. So I would request Sandeep sir to take over and
Malhar, just give me one more minute. Sorry to interfere. Sorry, speaker. So we Atal Incubation Center is funded by Niti Aayog and Andhra Pradesh Innovation Society, and we have invited the representatives of the both the funders for these sessions. And of course they are very busy, so some of the sessions they are attending. And today we are very happy to have Mr. Viresh Singh, who is a general manager of Andhra Pradesh Innovation Society, which is society under Department of IT that supports startup ecosystem in whole of Andhra Pradesh. So with that note, we'll proceed. Thank you very much.
Sure. Sandeep sir.
Yes.
Can you take over?
Yes, I will share the screen first. Just let me know it's visible. Is it visible?
Yes.
Yes.
Yeah. So thank you everybody, and thank you for inviting me. I will surely make an attempt and try and share some of the experience that I had during the acquisitions and mergers and acquisitions for startups, as well as some of the experience which is on the fund side, and what suits what, and how it moves. Before starting the session, I will just touch base upon few of the challenges that startups do face, and I assume and believe that all those who are in startups or have gone through this phase, they must be facing these challenges. The reason why I'm starting with these challenges is because after that I will just touch base upon the fact, before going very quickly to the funding instruments, is that what sometimes it is important to know that what the investor is looking in startups, and that's very key, because that will help you deciding what instrument and how to go about taking up the startup forward. So when I start with challenges, generally what we see these days is that there is fierce competition in startups, and there are ideas everywhere, and all the ideas, people think that it can be translated into businesses, and those can become super big activities. I'll just request everybody to mute. Yes. So the fact is that the competition is fierce in startups. That an idea which can come into any part of India can be also replicated in any other part of India with some amount of tweaks. So there is a competition. So there are a lot of options available when people want to invest, or people want to take over, or people want to move ahead with the startups. So competition is tremendous. So don't be complacent, because you may find yourself very quickly replaced by somebody who is the same line of business. The other thing is that unrealistic expectations. People expect significant, fast growth in the businesses as far as startups are concerned, and that is unrealistic. No business can grow. It can grow beyond a certain point for some period of time, but otherwise, normally it tapers down. And we normally see in all asset class that if there is a high return, then many people venture those businesses, and then the returns go down with competition. So unrealistic expectation is the second challenge. Hiring good people is a challenge. People are hired many a times. Qualified people are hired, and companies or startups pay huge amounts to them, and then they don't get returns from them. So hiring good people, good talent, good people to work with is always a challenging situation. uh, Individual startups generally avoid going into partnership as far as decision making is concerned, and that is important. You need to have 2 3 people taking decisions, so that your decision are robust, and you can think of your idea and can make it more practicable. So partnership and decision making is key, which sometimes we see it's missing. Then important one, financial management. Many people who are doing startups are from technical side or from business side, and they lack the financial management, and that is it's a big factor in startups not getting picked up very well, because at the end of the day, economics rules, right? Everywhere economic rules. So financial management, again, very critical. Cyber security. Many of big companies spend a lot of money on cyber security, especially the fintech startups. They need to be careful, because if it is not secured, then there can be huge challenges. We still don't know what cyber security means and what kind of theft can happen in cyber security. So cyber security is again a critical part, and with startups they can't invest too much because of lack of funds. So there is a huge exposure when you are using the public networks as far as the cyber security is concerned. And the last and the most important one is the winning trust of your consumers. So uh, you can start with some customers, but if you are not able to serve them properly, then you will come to a situation where you will see that consumers go away from uh, from your business. And that's your consumers are your best marketing guys. The happy consumer generally spreads the news, and then you get a lot of other customers. You can see and recollect that many of big companies, they are very careful about their reputation, and that's why they take care of their customers. So these are some of the startup challenges that generally we see, or when we see, or when I'm the other side of the deal, this is what we generally see in them. And that can be, and all of them can be showstoppers in going forward. Going back to the investing side, and before going to the methods of investment, see, it's very critical that there was a time in the earlier days when people just used to run for startups, and they used to put money in startups, and then they used to lose a lot of money because of multiple challenges. So what has happened is that the mentality of the investor is bit changing. They look at a positive EBIT in the startup, not immediately, but they look at a situation where they want to make sure that the startup is making some money. They do understand, or we do understand, when we are looking at a transactions, that it is not that easy to make money at the initial stage, but it has to be at least realistically a bit positive. If your startup is not a bit positive, then there is a tendency of not to put money, because if the investor start thinking that the person who is starting up just wants to give his startup to somebody and just make big money, those days are gone. So it is critical that you try to make an effort to make your EBIT a bit positive at least, or there has to be a plan or a clear structure behind making a business positive. So that's the most critical point number one, what an investor is looking when he wants to buy a startup. The other thing is that earlier there was a concept that only number of footprints and number of eye views and hits and all that will scale through, but that has also gone. People just don't get carried away by footprints and eyeballs, and they want real value proposition. They just don't want a hit to the site or to the portal that has been made, and they just don't get carried away by that, because that's just one of the indicators and not the best of the indicators. After that is internet. People generally who want to buy or invest, they want to see that what is the scalability of business. So use of internet, as well as how can it get how can you leverage the entire territory, and that can only happen these days with internet. So the startups with a better access and internet and a platform that can be used on the general web gets much attention than the startups who are not so good on the internet platform, or so to say on the cyber platforms. Then compliance. So when we look at companies, any given point of time, if anybody tells that can I invest or should we do that, we look at compliances, because many of the startups that they ignore compliances, and these days even government also has been very critical. So the direct tax payments, withholding tax, GSTs, if it is anything to do with RBI, if they are fin startups, and audits and everything, if they are ignored, then generally you sit on a lot of risks. And if somebody needs to invest and his name is attached to that, then that can create a problem. And it's not only the financial challenges, but it is a reputation risk also. So people do look at compliances, whether there's a mindset from a startup side to try to be compliant or no. And then the last and the most important one is that how can it become it can fit the broad business, because if companies have products, then they want newer companies or new startups to fit in their business, and that means either the technology can be used or the model can be used. So this is generally the landscape, the way we look at startups, or what we have seen in the past. So the challenges that startups have, and the way to look at it. So as you guys are probably aware that we look at it in four steps, and I'll surely cover it up in the later part, that how it is seen, in the sense at incubation center, and then the angel investor, and then the venture capital, and the private equity. So going with this, I will just take the presentation forward. Give me a second. It's just locked. Yep. Sorry. Yeah. So the old traditional ways, just to start any funding, what we have been told generally in accounting and in the old school of thought is that you have typically three types of ways of looking at funding. So the first one is the oldest one, which is the equity cell, probably the easiest one. If you are a company which is a private company predominantly, and the startup either is owned by individuals or a family or by friends, then you can just offload the part of equity. And when we sell equity, generally what happens is that you need to do a valuation, and that will be with some thumb rules. That is either you will do some times of your turnover, or sometimes of your at least potential profit and the prospect of profit, and then you can arrive at a share price, per share price, and then can offload part of that as an equity to the concerned buyer, and that buyer with an equity sale generally sits on your board, or he may stay away from your board, but just be take participation in your company operations. So a very old way of looking at things. People generally don't do that unless and until the startup has been doing so well and there is a direct investor that is coming up. Then this mode is explored. But initially at initial stage, generally people don't go for equity. They generally look at the second option, which is the debt financing. And debt financing, you can do it through multiple ways. A simple way is to get a bank loan, or initially, so that your equity is not diluted. The challenge with bank loan is that you have a fixed EMI or interest that you need to pay, and then after some time you need to start paying the installments also. Or initially, if you just need some funding, then you can just go for a short-term short-term overdraft facility, where you can just utilize the money and pay back. It is becoming a little bit old ways of looking at things. The third way, which is more or less the hybrid instruments, and we can talk about them. It is a mixture of debt, equity, and then you can keep a debt which can be converted into equity. So more or less, hybrid instruments are something that are more preferred. But these days we have more advanced instruments and simple instruments also, like ISEF, that have come up, which can help you generate funds much faster and with much lesser kind of compliances. So these are the three, by and large, ways, the main uh, ways of raising funds. Why it is important is because your investment decision is very, very critical. We have seen many times that if a wrong investor comes on the board, or somebody who has less patience, who doesn't believe in the scheme, generally will trouble you. And especially in equity sell, it becomes a challenge. And then to get rid of that investor is becomes a very difficult thing. And then companies go into challenges, and if those matters go higher up, unfortunately, then you have litigations, and the challenge becomes very much significant. You can't concentrate more on business, and you generally then go up into litigations rather than anything else. So the people who are in startups, they need to be mindful that what kind of investor that you are looking at, what is his vision, what is his intentions. Is it a short term that he's looking at? Is it a long term that he's looking at? What is the horizon that he's looking? What is the growth? What is the perspective? So it is important that you pay attention to what kind of funding mechanism that you are looking at, because a wrong decision can trouble you significantly. See, there are pros and cons with every product. So if you look at the vanilla products like debt and equity, there are pros and there are cons. So it's easy. It's easy to get away with a debt instrument, because you can generate it. You can have good funds. He has no control. If you are generating decent cash, then you can pay the debt and keep him happy and keep him out of your business. And it's a easier way to raise funds. So if somebody comes up and creates a debt instrument where you can just give some 50-60 basis points more than the current market rate, where bank rates have significantly gone down, almost nearing 6%. So if somebody gives you a debt instrument of about 7%, then it is easy to generate, because that guy gets a very quick interest income every month or every quarter, and that can move on. So there are pros and cons. If your business is generating liquid funds, and if you have ability to hold the debt or repay the debt, then initially debt can be a decent instrument to look up to. The second option, as I said, the first one and the vanilla one, is equity. The advantage with equity is that once you have done the valuation, and if you are able to get a good valuation for your business, if you are able to convince the proposed investor that the business is going to grow significantly, and the valuation becomes higher, then you can get a good amount of fund. That fund can be reinvested in business. The advantage is that there is no fixed repayment. If you generally make good amount of money, then you can declare dividend and pay the money. Or else, if the business flourishes significantly, you can just go and buy back the shares and repay. But there is no pressure. There is no pressure. So there is no worry about repayment. There is no repayment. There is no fixed repayment structure. So you don't need to be worried about it. The only challenge is that with equity is that the guy becomes equal owner. He sits in your company. He is a part of decision making. So again, your business decisions sometimes can be influenced, but the person can. Please mute. Yeah, thanks. So the guy sits in your on your board and can interfere in your. Please mute yourself. So the problem with equity is that if the guy becomes interfering, then he can trouble you significantly in your daily business decisions. And if you are a startup who wants to take some bold decisions or fast decisions, there can be an issue in those decisions. The cons, as I said, these are the things. So you are diluting your ownership in the company, and if your startup really flourishes, then you really want to get out of it, then the concerned a person who has invested in the equity also gets equal amount of money. So your control goes down, and if you make far returns with equity, then your returns also go down. So this is the cons with equity, but the advantage is that you don't have to repay anything, and you don't have fixed fixed interest or a principal payment that actually troubles you in case of a debt instrument. Then coming back to hybrid instruments, again, hybrid instruments also are very much old. They are not new. One way of looking at diluting the equity is through preference shares. As we all know, that preference shares are shares where those guys don't be a part of your management. You can just give preference shares, with a fixed preferential dividend, which prevails in market, and just you can just pay the dividend and move on. So the guy doesn't become a part of your company. He doesn't part of your management. He doesn't trouble you in decision making. So whatever little bit disadvantages that you have with equity dilution, those can be taken care of with preference shares. But of course, somebody who enters the company with preference shares always will want to have a convertibility factor, and he will insist after a few years that either these shares should be converted into equity, and if you are not able to pay preferential dividends, then he will compel you to convert it into equity, and again there will be challenges. So this is a kind of a hybrid where it's in between debt and equity. But if you don't want the management interference, which is the most critical part, and decision making control in somebody, then preferentials can be can be a good option. The cons is, as I said, you will have to pay dividend. Rate is fixed, and sometimes he can insist on the dividend in spite the company's in losses. Then in that case, the equity will get diluted, and your ownership stake will go down. So that's one of the options. And then the other challenge is that preferential shares are not, it's not a tax effective way, because if you have a debt instrument, then that is allowed as a tax expenditure. Naturally, your preferential dividend will be after your post-tax profit, so you don't get any tax benefit. So from a tax planning perspective, this is not a very well thought approach, so to say. But it's an intermediary. People can look at it if they think that intermediary option is needed, then preferentials can be looked up as an option. Just as I earlier mentioned, that preferentials can be convertible preference shares, and the person who is investing may insist that he wants it to be converted, but you can utilize a window of 3, 5 years, 7 years, and then can convert them. So you can buy a time. But again, as I said, that if it is convertible, then after those times are passed, then those shares will become equity shares, and the person will become the owner of the company and can trouble. And if you have convertible preference shares, then you have multiple challenges, because in the year when you are paying preferential dividends, you don't get tax benefits, so you are at a tax loss. And then after 3, 5 years, you become the equity shareholder, and then he starts again dictating terms on your decision making. So again, this option a little bit dated, but still used by some of the people, but not so recommended in the current situation, considering that we have this option, which is now very prevalent, and this has come up of late, which is called as the Indian Simple Agreement for Future Equity. So this is a modern modern instrument, and it's a very effective instrument. What happens with this instrument is that this is an instrument where you can get best of all debt and equity, or preferentials also. So you can create an instrument where an instrument has a very low dividend payout, which is which can be about 0.0001%. This is an instrument which is not a debt and not an equity at a stage. It's an instrument which can only get converted into equity after after a certain period of time. This instrument has originated from Silicon Valley, or Valley as they call, where there were more technical startups or technology startups and nobody wanted the traditional instruments, neither equity nor debt or not preference shares. So this is a combination which probably originated in year 2013, and in India also these are prevalent. And there are people who are who are angel investors or even venture capitals. Those are the guys who believe in this instrument, and people who have long funds to invest, they invest in this instrument. What happens is that if the startup picks up and if the valuation goes up, then this instrument gets converted into equity share. But if not, then, and if it fails, if the startup completely goes off, then this is the last instrument that gets their due shares. So then actually it's a money loss. The worrisome situation from an investor perspective is that it is risky for him, because he doesn't have anything. He doesn't get any dividend. He doesn't get any preferential treatment. So it is risky. So people who will or who want to invest in these funds will he will be he'll safeguard his interest. He will look at startup. He will evaluate. And as I mentioned, that if this is the route then that somebody has to take, then he will make sure that all the boxes, like is it getting positive EBIT, is it an effective startup, it can work in all the multi-facets of business, it has got a good internet base, it is compliant. And if because if this is the format of, or this is the fund that I need to invest, then the investor will be extremely careful, because he just doesn't want to put money in one place where it's just going to go haywire, because he has the least control. He is neither has an equity, neither has a debt instrument. He is neither getting any dividend. He is not getting any interest from the company. So this looks very attractive. If I am the startup, then I will look at this as an option. But I can surely tell you that if this is an option that you want to go in, then you have to really tick at least 6-7 boxes of business correctly. You just can't say that, okay, I'll get an ISF investor and just try and make a very rosy picture and then walk off from that, or a business just makes the losses and the person loses the money. Because naturally, as an investor also, this investor also really wants the startup to do well. And I can tell you that there are funds and there are companies who really invest in this kind of ISF funds, maybe 10, 12, and they know that the logic is that maybe only 33% of them will work, and 66% will their money will go into drains. But they take this chance because wherever it works, it can give it gives them significantly higher returns. And as you are aware that these people don't expect smaller returns like 3-5 times. They expect 20, 30, 40, 50 times of returns on their funds. So their model is that their 33% of investments will actually cover up their rest of the investments, and they still remain positive. So this is a very new and very lucrative way of looking at startup investment. But as I said, that it's not easy to convince somebody to come through a ISF notes and then not make the business sustainable. So a very lucrative one, but not very not very easy, because the person who will invest will surely look at a lot of lot of things, so to say. Then of course there is redeemable preference shares. This is a little bit of simplified way of preference shares, where you can have the person invest into preference shares, and rather than converting them, you redeem them. So if you make money, if startups the company starts doing well, then you can just redeem preference shares and get the person out of business, and the risk is less. So you still pay dividend, but there is no equity dilution that happens. So the worrisome situation with this is that in case if you make a losses, you still need to pay dividend, and if the redemption period is fixed, then after that particular period you need to redeem them also. So if the business doesn't pick up, then you really need to pay out of your nose. A better option, but then the person who is doing business needs to be mindful that he needs to generate money. So this is a very simplified way of preference shares, where you can protect a bit of equity and protect a bit of management control. So this is this can be used if you are looking at preference shares. Then you can equate between preference shares and redeemable preference shares. So this is one of the options that you can really look at. Then again, bit of wings of preference shares, where somewhere you can have participating preference shares. So these are shareholders who do participate in your business. So they have some kind of a say. Of course, you can manage the percentage. You can keep your equity or the startup or the company's equity beyond 55% or 66%, so that not major decisions can go against you if they are discussed in the board. But the same way, if it is a participating one, then the participating shareholders also feel happy that they are part of decision making. At least they can attend the meetings, they can really participate, and they can at least give their opinion, or their votes are at least registered in the board, that if they are not happy, then they can at least make a point. So this is a bit of little democratic way of looking at preference shareholders. So the good part is that you can lure somebody with participating preference shareholders, but the challenge is that you still have to pay dividends. Generally, if it is participating, then the interest rate or the preferential dividend rate is lower. So you can lower a rate and avoid a bit of a cost, so to say. But still, you'll have challenges, because then you'll have to have formal board meetings where you need to have these people participating, and everything will get recorded. And naturally, again, your decision making can be slowed, and you can't take some dynamic decisions if you are really looking at dynamic decision making. So these are some of the pros and cons. So if you're looking at preference shares, then you can look at vanilla preference shares, cumulative preference shares, participating preference shares, as the case may be, based on the way you look at your business and the model to make it profitable. Uh, Debentures, as I said, convertible debentures. This is very old way of looking at investment. Generally, very structured companies, very big companies, they do that. So some period of time, your debenture is a debt instrument with a ticket of interest, and then structurally, after 4 or 5 or 6 years or 7 years, this instrument just get converted into equity. But this is used by companies who who have broad equity, and they anyways want to go for funding. So rather than going for an equity issue or a right issue, they go for convertible debentures, get the money on board, invest money, make good profits, and then convert the debentures into equity, and then make the base bigger. So I don't personally think this is a scalable option for a startup. This is for more or less established companies that they go for convertible debentures. Uh, ESOPs. This is very prominent into multinational companies. It is very prominent into Indian companies also. The erstwhile era of ESOPs was that only senior management who is a part of decision making, they used to get ESOPs, and the idea is that it's a good retention tool for your talent. You can retain your talent through ESOPs, because there's lot at stake. So senior management get some shares at some price, and if share price increases after a lock-in period, they are able to cash their shares and really make big gains. So generally, the way it was used earlier was that it is a three-way way of looking employee compensation. So you pay him fixed salary, then pay bonus, and then pay ESOPs, so that top management can really make money also, and they are motivated, as well as they are part of your company, because you can lock them for a long period of time. So it's more of a retention tool. The way it is used in startups is that if you don't have any money to pay, but you really need a talent, be it IT talent or a talent which can really required for your business. If somebody is a developer, or somebody who's working on robots, or somebody who is doing multiple things, if that person has to be um, retained in the company, then every year you can pay some of his compensation as shares. And once the company goes through changes, and if some angel investor or a venture capitalist or some PE investor comes in, then those shares are sold to him, and that employee actually really get benefited. And the advantage is that the employee stays with you, but employee just doesn't become part of your ownership. So he just becomes part of your ownership, but very minimal percentage. So if you can control the ESOPs with your associates, say to up to 2%, 3%, 4%, or 5% of your equity, and then they can be a part of your company for longer period of time. and there's no immediate cash flow, and the guy remains motivated also because he thinks that if company is doing well, then then in that case I also do well and I have a good chance of making good money. So this is one of the older ways of retaining talent, but in a modern days it can be used as a lucrative payout. And with ESOPs you can actually reduce the fixed pay and the performance bonuses, so that your immediate liability and the hit on the P&L, which always is a challenge for startups, generally goes down. So a smart way of looking at things, but you need to be mindful that whom you are giving ESOPs and what is the lock-in period, what is the base price, and at what price he has a choice to exit. So these are things that you need to be mindful about. Also, if you are giving ESOPs, then you need to be mindful about the income tax compliances, because then there is a share valuation, then there is a perquisite valuation in the individual tax returns that comes up. So compliance is something that you need to be mindful about as a company and as an individual if you have ESOPs in your company. Now, going back to the investors. So, typically in case of startups, there are four tiers, what we call them as the investors. So, with the government initiatives and with Make in India and with many, to increase the entrepreneurship, the first stage is the incubation centers, where the smaller ideas with smaller funds, people try and invest, and then they try and cultivate the idea. Generally, most of these ideas are or on the e-platform. So either it is robotic, or or these are the companies with an internet platform, so they can make the difference to a certain extent, and to that extent, whatever funding that they require, that is being done by these centers. And then, of course, you go to angel investors, and then tier 3 becomes venture capitalists and private equity. So what happens with the incubation centers is that these are centers with a small setup. The ideas are also small, and they generally come as a byproduct of some system, and then they are funded by government. Many governments in India also are funding them to help people develop businesses which can then generate employments. And they are giving, they give some services, like they give some some land or some kind of a funding, or they give them some facilities within the government centers where people can start their activities. The startups can work in those environments. And this is the situation where the key part in an incubation center is the MVP. That's what they call it, as the minimum viable product. So the product viability is tested in this. So it can be at pre-production stage. Typically, we have seen in IT that or in robotic, that you generate the robot, but the testing happens. You may read some 25 tests, but you can do those tests, but it's still not fully workable in the commercial production world. So once it's implemented into production world, it just further needs to be tested. So many a times this MVP is always a criteria. So at least in these centers, the product comes to a reasonable MVP level. So it is at least a viable product. Sometimes some products just don't pick up, and you can actually just kill them in the incubation center. But otherwise, you can at least have a product which you can demonstrate and at least have some testing done. So this predominantly in case of the the IT or the film sector cases, where you have applications that can support some applications, and banks or financial institutions, they can work around those products, and those can fit into their requirement, and they can be then if it fits the minimum viable product criteria, then it can go to the later stage. So this is typically with the incubation centers. Angel investors, as I said, are the people who have already done some startup, or those people who keep some funds at their bay to be invested. So these people have funds, but they don't put their all eggs into one basket. So they invest between $10,000 in these companies, and they try and control. This is a risky phase, because it's sort of small money. but still the startup has just proved probably the MVP stage, and it can work, it can't work. It needs to still need to go to the commercial phase. So this is a risky proposition, but as I said, at this stage, they can go for a sort of an ISF equity cycle, and then they look at these products to pick up. And as I said that if this is an investor pattern, then they can look at up to 30, 50, 80, 100x of their investments, because they for sure know that their hit miss ratio is significant. They know that probably only 30-35% is going to work, and 65%, although it has passed the MVP stage, it will not pick up, and their money is going to go to drains. So if their three ventures have to be successful, then they need 100 times out of that, so that they really make their ROI on their investments. And they are ready to take risk, but they will be smart enough to figure it out, and they will take chances. So if you are a startup, then you need to really prove your MVP, and you need to really make your case look really good, so that you can lure an angel investor. This is a bit of a later stage. This can only happen if you are really a bit positive. Venture capitalists are big companies. They have lot of teams who can look at due diligence. They will look at the startup with multiple lenses. They will surely make sure that compliances are there, profitability is there, and it is scalable. The product is very stable. At least it has at least had a minimum 3 to 5 years of life cycle to the company, and then they will invest. They will surely make sure that they have management control. They will surely attend meetings. They will sit, and they will support startups with some kind of a knowledge also. So you can look at people who have already worked in industry, people who are independent directors, who have done some kind of deals, and those who have contacts in industry. These people will be a part of these venture capitalists, and they will sit in the company. Naturally, the control will be diluted, but at this stage, it will take company to the next level for sure. And from there, if the startup investors, as well as they can properly leverage the strength of the external directors, independent directors, and venture capital support, then you can make really company really fly, and then you can really go to a level to the next level, which is the PE investment, that is the private equity investment. And here you can look at lot of options of the combinations of equity, debt, convertible debt instruments. You can generate short-term funds, long-term funds. You can look at the external funding also. So external commercial borrowings, other commercial papers. Lot can be done if your company is at a venture capitalistic level. Probably, according to me, it has to be at least minimum 100-150 crore turnover. If that is not the case, then these people generally don't venture, and they really want a very solid structured growth plan. They need your product to be stable. It can't be at a MVP stage. It has to be a proven product. If it is a robot, or if it is a software, if it is an application, that has to be proved, and that has to work on multiple platforms, and it should suit the industry. So this is probably the penultimate stage. Not many people even reach this stage in their startups. If you reach, then you really already had your company is really into good cycles, and these are the companies that big multinational companies also look at, because if the company is competing with the MNC, or it can really work on an MNC platform, and it can really really do balancing with the MNC, then this is a time when MNCs also enter, and they can actually out and out go for a completely full buyback of these companies. And it is at this stage where the investors, as well as the people who have started the company, can really make good money from their own investors. If not that option, then you go for a private equity, which is where these people put significant amount, if that is required to be done, to an extent of 10, 20, 30 million dollars also. But when the company wants to go into this phase, then they should really have a good plan for investment. They need to really have a good expansion plan. And if you're able to convince a PE by doing valuation, and then they will have their terms and conditions that the owners and the real management should stay back and should be a part of for the company. One of the things that I will surely like to tell you is that if people are thinking that if at all my company goes to this level, then I just get a PE on the board and then I can run away with big bucks of 10, 20, $30 because this is a big amount. What we are talking about, it turns out to be 100, 200, 300 crores. Then please change your viewpoint. It's not going to happen like that. PEs make sure that the fund what they're giving is also invested in the company, and then the company really does well. All the management and all the people who have till the time have been a part of VC or they are part of the company, their lock-ins are kept, their amounts are kept in escrow, and they don't allow people to run away with the money. So, many cases, I don't know whether you guys read or know, but many companies who have gone into this route and they think that they will run away with the money, they don't run away with the money. That PE equity investor companies will make sure that the company runs, it really achieves its true potential. And then when the time comes, according to, or when the PE equity company feels that, they can offload the whole stake, that is a time when some big company will take over the company as a product. That is a time when the PE equity makes their money, and that is a time when the investors and the startup guys also make money. So just don't be under impression that if I come to this stage, then that's about it. Then I make money out of PE and I run away. They just don't make you run away from the businesses like that. There is a lot of lock-in periods, and your money gets significantly locked in into the funds. So you really need to make efforts till that point where the company really becomes valuable and some big group, any conglomerate from India, be it Tata or a Reliance or a Mahindra, somebody like that takes you over, or a global company takes you over. That is only a time when you really make money. And as I mentioned it's mentioned in the PPT that they look at a 15% of IRR, and that's not easy. So the product has to be really good, tested, and it should be sold into multiple markets. And the rest of the initial tick boxes are then assumed that there'll be a company, it will be a company which will be very well monitored, on compliances, on the rest of the platforms, and it is not lending itself into any troubles with the authorities. So this is the probably the last stage of investment into the startup businesses. Just to add to that, you can see key numbers. You can look at numbers. I don't, numbers are good to look up to, but it's not that you can get carried away with that. Currently, also we are going through COVID, so there is up and down between the numbers. But if you generally look at it, you will always see that the debt part is lower and the equity deals are more, because the person who is investing generally wants to have a equity share, because he feels that let him be a part of management, and then he can also dictate some terms. So you can look at it, debt to equity is significantly almost 80-20 rule. 80% goes to equity and 20% goes to debt. If you look at funding in H1, as I said that April, May, June are least to be seen, because we had significant lockdowns in most parts of the country. So Jan, Feb, March were significantly higher. March was highest. In fact, we were doing reasonably well in March. If COVID would have not been there, then economy was really picking the steam. GST had stabilized, and most of the other Make in India initiatives, and we were going through a good patch. Government spendings were high, so naturally the number of deals in March were very high. Naturally, they tapered down because of April, May, June lockdowns. But now that economy is back, we have seen the GST collections again crossing 1 lakh crore. Probably we'll see some kind of a uptide in the third quarter, but it's still a significant amount of equity funding that has happened in 2020. As I said, Q1 to Q2, it's not a apple-to-apple comparison, because it has straight away become 1/3 simply because of the lockdowns, and most of the part of India has been almost closed, and manufacturing just didn't work in first 3 months. So first 3 months of lockdown. So not a good way to look at it, but I think so. It's not at 2.9 million of Q1 level, but it can pick up to 2,000 level in Q3. Q3 data is still not available, so but it will be interesting to see what kind of data comes in Q3, and then we can predict something about Q4. Debt funding also, it remains into that 75-24, 80-20, and again has gone down in Q2. Q1, as I said, was a good number. We were picking up well, so even debt was doing well. But with COVID and lockdown, it has also gone down at a 20% activity. It will be interesting to see Q3. If you look at stage-wise funding, naturally early stage, the growth stage is double than that, and it's almost 2.5 times. So naturally, if you look at deal size, as I said, that once you look at the venture capital and then look at the PE funding, you will always always see the difference that the ticket size goes up and the deal size goes up. You will naturally see more surge in the growth stage and the late stage. But if you look at the number of deals, the number of deals will naturally fall. So at early stage, if there are 279 investors, then the P the venture capital, it becomes 72, and then the PE becomes 41. So that means out of two, you can simply take a ratio of only 1 of 6 activities are really picking steam when they go into the next stage. So a very good way to look at the statistics simply from the percentage of success in startups. If you look at the sectors, naturally in India still the fintech and financial services dominates. That's the best sector. With COVID, education sector has picked up. A lot of educational softwares and everything suddenly. With Byju's example, a lot of people are coming in that sector. So that is the bigger one. Accommodation in India also has picked up. A lot of new startups have picked up into rented accommodations and hotels, as well as the villas and stays and second homes and so on and so forth. So these are three ones which are the biggest ones where deals have happened. And then of course e-commerce, it's picking up. Healthcare will see a significant upside in coming times because of the importance that has happened from COVID. Logistics, there are multiple players, and that will always be there. And media, it's really surprising to see that country like us, there are not many agri tech things that are happening, but we can expect sooner or later that the way diversification is happening in India, I will not be surprised to see in 2-3 years time agri will be in top 3 sooner or later. So these are the industries. Good to see this, so that if somebody is starting, they can look at this where it is really working. But I can see that agri sooner or later will be our top thing, because the networks are increasing. Sooner or later, in 2-3 years time, we'll have 5G, and the way apps are getting developed, and India is still 70% agri business. We will have a lot of agri applications and tech activities that will pick it up sooner or later. And with the new farm bill getting passed in many states, also it will have a good good momentum sooner or later. So that's the industry breakdown of deals. So these are, again, as I said, these are the numbers. You can always see a presentation later and find it out that how many deals. Mentioned that 279 deals, and there was about 5.7% pickup in the new deals, and around 519 million in that. So at growth stage, typically 1/4 of them went into at a later stage, where still there is an uptick of about 4.3%, and the value suddenly becomes double. So about a 1.7 billion number picks up, and then out of that, as I said, that 1/6 deal goes into the later stage, and then the deal size just becomes almost 2.5 billion, which is somewhere around 18,000-19,000 crores. So you can look at it that how it moves. So 1 out of 4 just goes into second stage, and 1 out of 6 goes into the final stage. So that's the stage-wise funding. So typically that's from me. I can open it for Q&A, and to the best of my ability and knowledge, I will answer the questions if people have some questions.
Thank you, sir, for this insightful lecture. And I think the participants can, put in the questions in the chat section below, and we can take it up.
Sure.
I have a question, sir, here.
Sure.
So can you throw some more light on this ISAFE way of doing equity? And that is one follow-up question is, many of these debentures, convertible things, most of these, this kind of funding patterns is best done in a private limited company, or because why I'm asking this question is in the incubation center where I am working, most of the startups are firms and LLPs and partnerships. So what do you advise the best possible way of getting investment? What kind of format? Is it ISAF or debentures? Which would they prefer? Because of this local ecosystem, not many people are aware of equity patterns. They are more aware of typical conventional loan.
Yeah. So, okay, I'll answer. See, so I'll tell you. See, this is a very new way. ISF is still very new, and as I said, that it is a very simple instrument because it just gives benefit of both equity as well as the debt for the startup. Because in any other cases, as I said, if you have two advantage disadvantage. If you go for a debt instrument, then you have a mandatory interest payout, and then you have to pay the instrument principal amount also after stipulated period, or else it gets converted into equity. So there is a funding or cash outflow and cost associated to a debt instrument. If you want to avoid that and you go to equity, then the challenge is that the person will invest, but the moment person will invest, he will naturally want to be on your management side, and then he will interfere. And if he is not from that line, then his interference can be a trouble. So decision making will have to be more structured in terms of meetings and discussions. And if he is not agreeing to the investment, then there can be a bottleneck and things won't move fast.
Correct.
So that's where the equity challenge comes up. So coming back to your first point, the ISF, the advantage is that it is very simple. The guy is ready to invest, doesn't want equity also. He wants equity after some years and doesn't even want debt because his dividend is at 0.0001%. So he doesn't want that. But having said that, one has to be careful that if somebody is going to give you this kind of amount, then he will be extremely mindful about his money. He doesn't want to do charity, right? This is not a charity that
Correct.
we're talking about.
Correct.
We're not doing a charitable activity or a social CSR activity, right? That where money is only done for charity, which will have no return against that. So he
Right.
ultimately wants to have money from that. So as I said, that these people who will be ready, they will really, really see the product. They are smart people. They have appointed people in their companies to look at the product, what will work, what will not work. So they will do a very clear due diligence about your startup in your incubation center also, or at that stage. They will really check out whether the product is really has an ability to go to second stage or third stage. If they are fully convinced, then they will put this money, but they will keep a close eye on your activities. They will not just put money just like that. And the second thing is, as I mentioned, they will clearly make a point that this money that is coming to you will be invested in business. So you will not get a money. See, the point that everybody needs to be understanding is that there's a little bit of a math, and there is a the people are thinking that I will start, a lot of kids, lot of B school graduates, lot of people, engineers, chartered accountants, they and those who come up with some ideas, they think that I will do a startup and then immediately there'll be money. I will sell it at one point of time, however loss making it is. Somebody will just buy the product and then I'll become rich. That's not going to be the case. For your point, if I become an ISF investor someday or the other, the moment I pay the money to that guy, I'll tell him that put this money into business. So let the business grow. So he will compel you to come to level 2 and level 3. So so that is the point. And to your point earlier, again, you are absolutely right that if your startup is a partnership firm or a sole proprietor firm or an LLP firm, in that case you have a lot of limitations because You know, all the debentures, all the preference shares, all these options are available if you are a company. So if you are really either of these entities, which is a partnership firm, LLP, I would say is still a little bit better because LLP is as good as a company and has got a lot of options available. But conventional sole proprietor firms and partnership firms, if they are, then you really have very limited, chance of funding, and the only funding that can happen is
Loan.
through the loan or the deposits, and naturally those are very rigid ways of looking at things. And in those fundings, you have a lot of challenges. You have fixed interest that comes up. The other thing is that if somebody is giving deposit to a sizable amount, then he may ask for a collateral also.
Correct.
So he may ask for your house or your property or your some tangible assets. So that's not a workable option because he may ask for a tangible security against the deposit, maybe a gold or something like that. And those options then are not very feasible options for your startup, because the moment you are startup, then some kind of challenges, some kind of liquidity challenges, some kind of profitability challenges have to be considered. So
And I also see that as a manager in incubation center, the kind of value proposition you bring in terms of mentorship and networking and leveraging, traction building for startups through equity, the VC or angel, that would not come in loan.
no, it will never
The
come
kind
in
of
loan.
the knowledge base you get it, in the equity, because the one who is depositing equity or one who is putting money in your company, he also wants to grow. So he would positively involve in the activities of the company, especially in marketing and giving global foothold,
Absolutely.
which does not
Absolutely.
happen with loans.
No, no, no. So see, it's like this. Anybody who wants to invest, and his inclination most of the times is through equity. See, because even debentures, his inclination will be lower, because if I have to just go for debentures and if they're not convertible debentures, then why should I go to startup? If I'm only interested in 5 or 7% or 6%, which is current bank rate, that is either a
FDI, you can
dividend
put
or a
FD.
interest, then I might as well go to a bank or a financial institution and keep my money there. Why I
Right.
come here? See, if I'm coming here, then I'm also taking a risk. And if I'm taking risk, then I want return. So
Correct.
I will be inclined for equity sometime or the other, because I just don't want a debt instrument. A debt instrument can be just an entry. I can just take a middle path of getting a debt instrument to work around for 2 3 years. But I will always will like to have a equity stake sooner or later. So that's always going to be the case. No
Right.
way the guy will be in debt instrument for a long period of time.
Then is it possible that if it is I'm giving an example here, there is one company with us was incubated and is a partnership might be like, as you said, if he can go for ISAF pathway where it's a middle path, he can invite people to invest in the form of a debt or loan initially, and later point of time, the company should be converted into private limited company for him to give equity, right?
Yeah. So you can do that. See, if you can do a MOU in that case, then you are the only option remains is that it has to be a legally weighted document, which has to be very clearly mentioned that if once these milestones are reached, then we will convert this partnership or LLP into a private limited company. Once we see that there is a value in this venture, and then the rest of the options initially maybe then an ISF can be done or an equity can be done, and then that can be taken care forward. But
Right.
a very simple question, at partnership and at sole proprietorship, you have very limited options. You can't have many options there.
Yeah, got it.
You have to initially then you have to do a memorandum of understanding, which has to be properly legally weighted by a proper lawyer, that at what point of time you will be compelled to make a company from this thing, and then from company you can take it forward to the second stage and to the third stage.
All right, wonderful. Thank you, sir. Thank you for the elaborate, answer.
Thanks. Anybody else?
There are a few questions in the chat box. Maybe if you can take it up.
To see a chart.
Malar?
Hello.
Right.
Sir, can you see the chat box?
1 second.
Okay, see, there is a question here. Could you explain more about revenue-based funding?
check. Huh? Okay. So exactly what revenue-based funding in the sense, uh, what the more the revenue, the funding should change.
Manogna, can you know explain a bit, elaborate your? You can open your mic and.
Hello, can you hear me?
Yes, yes.
Yes.
Great. Recently, I came across this company called Awage. They are a company who put out this statement saying that they can invest in startups starting from 25 lakhs to almost 5 crores based on revenue-based funding. So for seed level companies, they are open to consider the potential projections of the company and look at pre-revenue and startups which actually broke a pre-revenue stage to get more capital like a bridge fund. So I wanted to understand revenue-based funding and bridge fund in terms of startups which just broke the pre-revenue stage.
So see, it's like this. Then So see, once you have started revenue, then your revenue projections. So they will invest based on your revenue uh, revenue estimates, and at least you will have to show some kind of a cycle that how your revenues are going. So you need to make a projections, and you need to really. So it's like a more or less an activity where you prepare your budget and you try and meet your budget. So you will hit this number in first quarter, this number in second quarter, this number in third quarter, and based on that they will start releasing the funds. So if you go to this level, then they will release that much amount, and so long and so forth. Again, going back to the thing, so if you are there, they're investing, then what mode of investment, that again has to be seen, because if it is a debt or it's an are they going to come into equity, that will have to see, because only revenue can only be a deciding factor that what will be your valuation and what kind of what kind of what is your capital structure that uh, you will propose to them. So if you hit this revenue, then they will give this much of money. So that money will be what? It will be a debt, a loan, a intercompany deposit, equity portion, a debenture, whatever out of that has to be evaluated based on requirement. But I can tell you this, that if somebody is giving this proposition, then the 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 startup has to be at a level where it has really starting generating revenue. It has to have a very structured revenue model. It never happens at an initial stage. Your product, that means, has to be tested. According to me, the product must have clearly passed the MVP stage of minimum viable product, and the product is at least in go live stage. Because see, when you are looking at a revenue base, your revenue will only come if your product is scalable and it is sold. Okay, especially in an IT environment or IT setup, if you are not able to serve your product is not able to serve the benefit to the customer, how you will be able to make a commercial contract for revenue, right? And he will not give you revenue. And if you want to have a revenue, then you need to have what you say, either it has to be a subscription based revenue, or you need to sell and do it. So in order for that to happen, you need to have a product which has passed the commercial test fully. So
Can I add a point here, sir?
sure.
Manogna, see, this kind of funding, milestone-based funding, if I may say so, is very common with the funding you get it in the incubation centers through government schemes. Like, for example, BIRAC, Biotechnology Ignition Grant, DST has Nidhi Prayas grants. There are so many grants are available from government side. Though there also BIRAC takes certain equity from the company, but there the release of the funding is based on the milestone, not exactly based on the revenue. If revenue is the one of the milestone, yes, okay. But if startup has idea stage and validation stage, IP stage, and a testing stage, like that, if you have certain milestones which are proposed to the government and the government has agreed on that certain milestones, you will get the funding based on that. milestone based.
Hello.
Yeah.
Yeah, please go on.
Sandeep sir, there is one more question which is raised by Siddharth Reddy. Can I go ahead for it? Can I tell you? The question one is for small scale startup, which is the best equity sale or debt finance? And the second question raised by him is that is hybrid instruments like IPO?
See, initially, I would surely suggest that it has to be debt finance. IPO, you only do at a very later stage when you really have, because the whole complication of IPO itself is it takes so much of, so much compliance or requirements to do that. And then you need so much of, initial cost to do an IPO itself that that only will be able to, you will be able to only do it at a much later stage and not at a not at an early stage, very clearly.
And there is another question.
Okay.
Which is the good method for valuation of a tech startup in the early stage?
Sir, I think we can take this question up in the next session, which will be at 3 o'clock, which will be specifically for valuation of startups, right? So I think let's take this question up in the 3 p.m. session.
Right. Okay.
Thank you.
Any more questions? I request participants, if anybody has questions, you can open up and switch on your mic and speak out, or you can type questions here. We have some time.
Shiva sir.
You're right.
Shiva sir,
please.
question.
Right.
ఈ అగ్రి బేస్డ్ స్టార్టప్స్ అంటే మన మష్రూమ్ సంబంధించి
రైట్
మన ఈ స్టార్టప్ ప్రొడక్షన్ వరకు చేయగలుగుతుంది, ఫ్రెష్ మార్కెట్ చేయగలుగుతా ఉంది. అయితే ఈ వాల్యూ అడిషన్ కి వెళ్ళాలనుకున్నప్పుడు ఆ టెక్నికల్ సైంటిఫిక్ బ్యాక్గ్రౌండ్, ఆ తర్వాత ఈ రిసోర్సెస్, ఇట్లాంటి కొరత తీవ్రంగా ఉంది. ఒకవేళ ఉన్నా కూడా ఇప్పుడు నిర్వహించగలిగే స్థితిలో లేదు. అందుకోసం అని చెప్పి ఆయా ఫీల్డ్స్ లో ఇప్పటికే ఉన్నటువంటి కంపెనీస్ ఏవైతే ఉన్నాయో అట్లాంటి వాటితో టైఅప్ చేసుకొని ఈ ప్రోడక్ట్స్ ని మనం మార్కెట్ లోకి తీసుకురావడానికి ఏమైనా అవకాశాలు ఉన్నాయా? ఉదాహరణకు ఇప్పుడు పికిల్, మష్రూమ్ బేస్డ్ పికిల్ ఇప్పుడు ప్రియా పచ్చలు ఇట్లాంటివి ఉన్నాయి ఆల్రెడీ వేరు వేరు ఫీల్డ్స్ లో. అట్లాంటి వాటితో టైప్ చేసుకుని మష్రూమ్ పికిల్ ను ప్రమోట్ చేయడానికి అవకాశం ఉందా? ఆ తర్వాత ఈ హెల్త్ ఇమ్యూనిటీ బూస్టింగ్ ఫుడ్ ప్రొడక్ట్స్ ప్రాసెసింగ్ యూనిట్స్ ఇట్లాంటివి ఉన్నాయి కదా కొన్ని కంపెనీ ఏవైతే ఫుడ్ ప్రొడక్ట్స్ అట్లా ఈ ప్రజెంట్ కరోనా ఎదుర్కొనే ఇమ్యూనిటీ బూస్టింగ్ మష్రూమ్ బేస్డ్ ఫుడ్ అని చెప్పి ఆ తర్వాత ఇట్లాంటి అట్లాంటి కంపెనీస్ తో కలిసి చేయడానికి అవకాశం ఉందా అని. ఆ తర్వాత ఫార్మాస్యూటికల్స్ లో ఇది సార్ నా క్వశ్చన్. అట్లా ఉన్నట్లయితే డైవర్సిఫై చేయడానికి అవకాశం ఉంటుంది.
Okay, this Mr. Chandramohan is speaking in Telugu language. Is our incubator. So I will translate. His question is not directly related to the investment landscape or valuation thing. He is asking rather than taking an investment, because he is looking at scale up. Okay, at this point of time, he is able to grow mushrooms in a huge quantity. But his next step is to, as a follow-up, is either go for value addition through dehydration or pickling or any other technology, or to give to B2C. In both the cases, he might be needing certain investment. So his plan is rather than taking an investment, why can't I tie up with someone so that I can burden the shoulder to put this burden on somebody else's shoulder. Because I may not be able to handle that much investment, because I don't have that understanding of investment and how to do these debentures or equity capital and all. So simply, why can't I say, collaborate with someone who can do the rest of the job for me with their own money? So would you like to answer to this, or can we take it up some other time?
I think what we can do is that this is a very unique use case that sir has asked. So I think we can handle this on a one-on-one basis.
In mentoring session.
Yes.
Okay. Right.
And successfully have a unique solution to this unique problem.
Right. Okay, Chandramohan Garu, we'll take up this question in one-on-one mentoring session, because this particular session is only about equity and how to know what kind of investment opportunities are available. Your question is more related to marketing and
Valuation.
Yes, that's basically diversification and scalability. When that session comes, you don't forget to mention these questions. We will discuss in detail.
Okay, sir. Thank you, sir. Thank you so much.
Yeah, sure.
So if there aren't any more questions, I think we can conclude the session.
Yeah, no problem.
So thank you, Sandeep sir, for joining us today and explaining us these complex, topics. And definitely, we have learned a lot today. And I think any more doubts, we'll just take it from the participants on mail also. And if you could, help us out sometime later, that would be great as well. But
Sure.
This was definitely a very insightful session. And thanks again for joining us.
Thank you. Thank you, everybody.